When you look at SPACs, you look at ETFs, some of the biggest names out there are really kind of dominating the market scene right now. And today we're going to dive into it with Morgan Creek Capital and Mark Yusko. My name is Paul Barron, and this is Tech Path. The biggest thing we get more and more on the channel is really kind of the topics around where investment strategies are going, also the kinds of investments that are happening, whether you're going into an ETF, looking at a SPAC, or you're going into something much more long-term into a traditional stock play. So today we thought, hey, let's get Mark Yusko on, the CEO of Morgan Capital. Thank you for stopping in, man.
No, thanks for having me, and looking forward to the conversation.
Sure. Mark, let's go into Morgan Creek and kind of the whole concept around your XO relationship, the SPAC organization between the ETF side of it. Talk to me a little bit about what you guys have created there.
Yep. So all of this really goes back to the kind of the roots of Morgan Creek, in that we've always focused on innovation as an asset class. Right? There's really four big asset classes. There's stocks, their bonds, their currencies, and commodities. But ultimately, innovation drives the creation of the companies that allow you to invest in stocks, bonds, currencies, and commodities. So we've done a lot of investing over the years in the private markets. And one of the things that you have seen over the past decade or so is companies staying private longer. And basically, the late stage venture capital funds growing bigger and bigger, and the walled garden basically protecting the wealthy from the masses, that they're not allowed to invest in these great companies. So the SPAC market has evolved over the last few years to really democratize access to those great companies. What we talk about is the companies of the future. And we started a venture capital fund focused on blockchain technology 3 years ago. And in the follow-on fund, in our second fund, we invested in Exos Capital, or Exos Financial. Brady Dugan, former CEO of Credit Suisse, really one of the fathers of building the team responsible for being the axe in SPACs today at Credit Suisse. They underwrite the vast majority and really know all the great ones over time. Brady brought that same ethos to Exos, which is a digital investment bank, a bank for the future, and started building out the expertise. We first partnered a year ago in a fund, a hedge fund that does SPAC arbitrage. So you're basically buying the SPAC IPO, or in the aftermarket, you hold until the deal announcement, and then you take your cash back plus interest, and you get the warrants, compounds in the low to mid-teens, much better risk reward than fixed income today. And while we were doing that, we got approached by some people who said, hey, well, that's great, but we really want to own these post-merger combined entities. So we put together an ETF, an actively managed ETF, that really focuses on providing the average investor with a portfolio of what used to be late-stage venture capital investments that are now liquid in the public markets, and put together SPXZ in January of this year, and put that out there, and excited to have that product as well.
Yeah. So this lines up very similar to what ARK is doing with Cathie Wood, and kind of the whole asset class of innovative companies that are breaking into this category of trying to look at these somewhat reverse merger type scenarios to go public. When you look at SPACs in general, I mean, we've seen, and I think you're dead on with the fact that, what you're trying to do is kind of break down those walled gardens, so to speak. Even, we had Warren Buffett kind of talking to this point, just his past earnings call. Or his earnings report.
Well, of course he would, right? He lives in a walled garden.
That's the old guard. Yeah, that's the old guard. Yeah, exactly. So when you look at that in Wall Street in general, there are a lot of opinions now that are still speculating that SPACs might still be, I won't call them a fad, but just are not necessarily the long-term play. You think this is potentially the new way of doing business. What are your kind of thoughts on that?
Look, it's so funny. It's not shocking or surprising that those being disrupted would criticize the disruptor. So Not surprising that Warren Buffett would would make a comment about SPACs, making it harder for him to do deals. Look, when you're basically a monopolist or an oligopolist and you don't have to compete for deals because you've got a tax advantaged structure all to yourself, that's great. Or venture capitalists, late stage venture capitalists are protected by accredited investor standards that basically say if you're not rich, you're not smart. Just a silly concept. They love the fact that the average person was prohibited from investing in these later stage venture capital companies. And this is not going away, right? And SPACs are an investment structure, right? They're a legal structure. And they're not a thing, people want to call it a bubble. Are there individual companies that went public using a SPAC that are highly valued? Of course. Are there ones that are undervalued? Absolutely. Are there traditional IPOs that were overvalued? Absolutely. Are there traditional IPOs that are undervalued? Of course. So if you think about what happened to the SPAC industry, it really changed for the better, and I think permanently in 2015, in that for the first 30 odd years, it was a dark alley, right? It was, I like to call it the NIT tournament of money raising. Nobody wants to go to the NIT tournament. They all want to be the NCAA. Some teams do go, and they actually do crown a champion, although nobody really brags about it. But in the old days, SPACs were where you went if you couldn't get public in the traditional markets. And so not surprisingly, it was lower quality companies. It was some sketchy types, some financial promoters that were foisting their bad merchandise on the unsuspecting public. And shockingly, maybe not so shockingly, the performance was bad. In 2010 was the height, right? In 2010, 60% of the SPACs raised had to liquidate. They couldn't find a deal to do. By 2015, because of some pending changes in the rules, that was down to 20%. And in 2015, they passed a series of changes. One, you don't have to have an operating history to go public. Makes sense for a company of the future. You didn't have to have profits. Makes sense because a lot of these companies are building new industries. And you could make forward-looking statements, which was the key because fast growth, innovative companies where everything is about the future, not the past, need to be able to storytell. And a perfect example, last year, what we call the year of the SPAC, set records for number of SPACs. 1 out of every 4 IPOs was a SPAC. Based on dollars, 53% of money raised was in SPACs. Actually, there's information content in the bigger deals mean higher quality. And here's the thing. If you think about those trends, they were really across 5 major industries. 2/3 of all the SPACs were in space travel and exploration, space tourism, electrification of vehicles, autonomous driving, online gaming, and esports. Now, those industries' best days are ahead of them, not behind. How many space tourists are there today? 0. In the future, there will be more than 0. Now, it won't be me, but a lot of people I think are going to do that. So having a company pursuing that makes sense. How about online gaming? If you would have told me 2 years ago, there'd be people at the Kentucky Derby explaining how to bet online, I would have said, no, you're kidding. No, that person actually had more screen time than the horses. I wanted to see the horses, not the person explaining how parimutuel betting works. Same thing with ESPN. They'll tell you how to bet an over-under. So online gaming is a big deal. How about esports? More people will watch esports this year than every other league in the US other than the NFL. More than the NBA, more than the NHL. The guy that won, that won the Fortnite World Championship this year made more than Serena for winning Wimbledon. That's awesome.
I love it. Well, that shows, you're exactly right. It shows the innovation and the shift that technology is imposing on society. And it feels like there's just this old guard that just is, it's kind of like almost the industrial age of the evolution of where we've moved to the next, the next arena of where financial independence is kind of going to be governed. And I think you're right. We've seen, the rise of Robinhood. We've seen, obviously, cryptocurrencies, which we'll talk about in a minute, kind of reset the table on investing as a whole. And when you look at this, the innovative companies, I think, are the ones that really are going to make the middle class wealthy again in the future, which whether they use it through utilities like a SPAC type scenario, which is really kind of the only offering they've got available to themselves, including a guy like me that's investing in someone like a Lucid or someone there in that range. So definitely see that as the trend. Let's talk about how you not necessarily pick, but obviously you do have to pick some winners here.
Yep.
I looked at your investment portfolio, obviously very heavy on EV, very innovative companies. I looked at, I think it was both XL Fleet and also View, two different, one XL Fleet being electrification of fleet vehicles, View more of a smart glass company. Talk to me about some of your positions and kind of why and where you're going with companies like those.
Yeah, so a couple things that are important about SPACs, right? SPACs are solving a problem that has been going on for the last 20 plus years in that we've been de-equitizing. The private equity business has been taking companies private. It's very profitable for private equity firms, very profitable for the fat cat investors, not very good deal for the individual investor because it takes inventory off the markets. So SPACs have brought back now 500 plus companies public. And the exciting thing about that is there are going to be some monster winners. And whether it's in electrification of vehicles or autonomous driving, look, I can imagine a future not that far away where you'll be in the back of your car being driven and you'll pull into the fast charging station. You won't get out of your car to plug a piece of plastic into the machine, right? The car will pay the charger with cryptocurrency. Then it'll pull away, you'll get on the highway, and you'll be stuck in traffic, and the car will pay to go in the fast lane. And then the cool thing that I want is you'll be able to pay ways with crypto for the premium version that takes me on the short way and gives everybody else the long way. So that probably won't happen, but it could be interesting. So what I think SPACs are doing, what I think SPACs are doing is they are liberating the opportunity set for the average investor to participate in these companies of the future. And we've noticed a couple things. So Exos does a couple things really well. One, they underwrote, the teams underwrote a lot of the SPACs when they were at CS. So they just kind of know how the process works. They know the good sponsors, the bad sponsors, the good industries, the less good industries. Secondly, they are really good at technology, and they built some incredible AI and machine learning technology that has helped us go through the history of the data. And there are trends. And one of the trends is that larger SPACs actually do better than smaller, which makes some sense. The markets are efficient in allocating capital to good deals over bad deals. So we start from the standpoint of the largest SPACs. Then we own them in our SPAC Plus portfolio doing arbitrage. When the deal is announced, then the great thing about the SPAC structure is you get to choose. As an investor, do I want to participate in this deal? If you think it's a good deal, you stay in. If you think it's a bad deal, you get your money back plus interest, and you get to keep the warrants. It's a beautiful thing. So then we look at the industries that we think are these companies of the future, fast growth, innovative companies. And if you think back to history, right, the best investors in the world, whether it's the Yales, the Princetons, the Stanfords, the UNCs, the Dukes, the Notre Dames, they have all overweighted innovation as an asset class. And we've been doing it for a very long time. And I think ARK and those guys are really innovative as well. Most of the best returns were made in the private markets, in the venture capital market. And now we have a chance through this kind of reverse process of staying private longer. I mean, think about Amazon. Amazon went public after raising, I think, $65 million in venture, not very much. It's been public for 21 years. But here's the problem. It's a very volatile stock. It was a company of the future for most of that time. So how many people bought the IPO 21 years ago and held to today? I say there's four. There's Jeff, there's his mom, there's his dad, and his ex-wife. Now, why did nobody do that? Because it's really volatile. Every year, Amazon has had a double-digit drawdown, including this year. The average is 31%, 5 times more than 50%, twice more than 90%. So the volatility is incredible. And one of the things I get really tired of hearing the media, the traditional media, talk about is, oh, the bubble is crashing and SPACs are going to go away. No. In investing, if you are investing, buying something where you think the price is lower than the value, and you have a long time horizon, you'll make a lot of money. If you're trading, where you're basically looking at the price of something going up or down, you have a chance to make money. Most people don't. If you're gambling, right, buying something that you know nothing about just because the price is moving, because you couldn't gamble on sports and they gave you a bunch of free money with the stimulus, and so you put it in Robinhood and you're speculating or punting in things that you saw on Reddit, you're going to lose your money. And that shouldn't surprise people. So to conflate speculating and gambling with long-term investing is silly. Long-term investing is the only business I know. When things go on sale, people run out of the store. If you believe in the industries, if you believe you can identify industries of the future, companies of the future, and the price goes down, you should actually buy more, not less.
Yes, buying opportunity. Yeah, I think a lot of modern day investors are starting to think in this way just because of you look at, I listen to a lot of the theorists on cryptocurrency, and they use a lot of references to like Metcalfe's law, which is kind of this, it's this growth effect of the social effect of people talking and moving and getting education out there on how something might move in terms of both stocks. I mean, obviously that's the GameStop model all the way. Okay, so when you look at these kinds of companies, the innovative companies that are kind of moving into this space, which you're dead on in the sense that primarily these SPACs are these kinds of companies, are there specific companies that you've seen? Let's just take Lucid. I know they're on your list of investments, and where they kind of came from, where you have companies that maybe, I won't say struggling, but Lucid has met with a little bit of a challenge, even though they're in an absolute innovation blitzkrieg opportunity here.
Yep.
What do you see with companies like that coming out in? Because could they give SPACs black eyes, I guess would be the question.
Look, the reality of active management is you're not going to get them all right. And the beauty of venture capital is you don't want to get them all right, right? If you're doing venture capital the right way, you want some zeros. Literally, you want some zeros, right? Because if you have zeros, then the power law says you're likely to have an equal number of big winners, 10 baggers, 20 baggers.
Unicorns.
And that's how the power law works. It's not like traditional investing where you're buying a dividend stock and hoping it compounds at 7 or 8% over the long term. Here, you're taking a bet. And it is a bet in the sense that we don't know the future. We don't know which industries are going to become dominant. We don't know which players in an emerging industry are going to become dominant. So we have an idea of what we think are good management teams. We have an idea of what we think are good business models. We have an idea of what we think are sectors or industries that we've been watching for a long time or trends that are durable. But at the end of the day, we have an active management approach because we're going to make mistakes. Look, in this business, if you're a legend, right? If you're the best of the best, Julian Robertson, George Soros, you're right about 58% of the time. But as Soros said, it's not whether you're right or wrong. It's how much money you lose when you're wrong and how much money you make when you're right. And so the idea is to cut your losers fast, right? To recognize the mistakes. And when the ones that you think you're not mistaken on and you think are really emergent winners over the long term, you rebalance those back to a full position as they get cheaper. So it's this constant active approach of evaluating, are they executing on their plan? Are they achieving their milestones? Are they in an industry that has a tailwind versus headwinds? And ultimately, we don't judge ourselves by getting individual companies right in the short term. We judge over the long term, are we invested in a good number of these companies of the future, the Amazons of the future?
Sure. So long answer for a question there. Do you like Lucid? Obviously, they're in your portfolio. Do you like them long term?
Today we do, and we think they're in a good industry. We think they're in a good segment of that industry, and right now we think they're executing. Now, could things change? Of course. Could they struggle, or could somebody outcompete them? Absolutely. But they're in the portfolio because right now we believe they are one of these companies of the future.
Mm-hmm. All right, so I like all of this. I mean, you're talking our talk. When you look at Fintech, let's kind of go in that direction. You guys kind of lean in that, you kind of lean in on that element. And I'll go back to, Buffett and what Munger was, Charlie and Warren were doing. They've kind of exited the bank business. Okay, they're dropping out of all their bank investments, including PNC and many others, regional banks, national banks. With that kind of move from the old guard, is the writing on the wall for the banking system going into what seems to be one, a transition into fintech, and then a lot more movement into the cryptocurrency and alternatives in terms of the monetary systems? What are your thoughts on where that tech is going to drive monetary systems in the future?
Yeah, look, banks have been under attack for decades, and banks broadly have been a pretty lousy investment
Yeah.
as a group, really since the global financial crisis began. And there have been some dead cat bounces, and there have been some individual startup banks that are interesting. And we recapitalized One West and made lots of money on that recap because the FDIC guaranteed us 2 times our money before we even started. So it's not that every bank is bad, and not that banks are going to go away tomorrow, but there's no question that the writing has been on the wall for a while, that we have been in a fintech revolution, right? If you used to get a mortgage in the old days, the banker lived in your town, he knew your name, he knew where you lived, he knew your family, and you borrowed money from them in what was called hedged finance. They expected to get paid back principal and interest. And then over time, we went to speculative finance, where they still kind of knew you, but the banker you knew got promoted to another town, and then your branch got taken over by another national bank, and so it was kind of nameless, faceless institution. But they would still lend you money, and now you could buy a beach house where you weren't going to pay back the principal, but you could make the interest payments. But now we live in a world of Ponzi finance, where nobody knows anybody, right? It's all sliced and diced and securitized and sold away, and banks don't keep risk on their books anymore. And basically, nobody wants to pay back principal or interest. They get bullet loans and all kinds of fancy financial engineering. So what do you do to get a mortgage now? You go to Rocket, or you go to one of the direct peer-to-peer lenders to get a loan. You don't actually walk into the bank and fill out paperwork. We're invested in a company called Figure Technologies that took home equity lines of credit from a 90-day ordeal to 5 days. And they tell you in 5 minutes whether you're approved, and the money's in your bank account in 5 days because it's all digital, no paper at all. So all of these trends are durable, and they're going to be a very big deal going forward. And the big one for me is triple entry accounting is one of the great innovations of our lifetime. And people don't really understand or appreciate what it is. That in the good old days, right, I would lend you money, right, and I would write down in my book that you owed me the $100. Now you had to trust me that I wrote down the right amount. What if I wrote down you owe me $200? How could you prove differently? Because it's in my book. So then the Medicis came up with this idea of, hey, how about 2 ledgers? How about we each have a ledger? But what if you write down 100 and I write down 200? Well, we need a intermediary, and the Medicis volunteered. They get paid for it nicely. And the Rothschilds and everybody else in banking basically became the middlemen. And they've had a 700-year great run as middlemen. Well, with triple entry accounting, now we don't need a trusted third party in the middle. If I want to send you money right now, you're in Florida, I'm in Chapel Hill, I have to have a bank account, you have to have a bank account, and they charge us a fee to send you the money. Now, if you were in Latin America and it went across an international border, we'd have to pay the Rothschilds, because it has to, 2 banks have to get paid if it goes across international borders. The Rothschilds own them. That's good for them. And why do we have a treaty 400 years old that we're still using, right? If I have a Bitcoin and I want to send it to you, you don't have to have a bank account. I don't have to have a bank account. And we can do it instantaneously. And if you're in Latin America, I could do it instantaneously. So all of these trends are going to continue, and the banks will be further marginalized to custodians and record keepers. And they'll still do service, and they'll still be hopefully in your communities and making small business loans. But at the end of the day, the move by Buffett is not unexpected. But the fact is he hadn't made money on those investments for a long time.
Right. Yeah. Well, and right, you're seeing this kind of transpiring across a lot of industries, even including, to a certain extent, the old, automotive industry, which is now struggling to try to make the leap into this new categorization of electrified vehicles. We're seeing it in the energy industry with solar and wind starting to move into placement. And obviously, you mentioned earlier with space becoming really kind of the new merchant carriers of the future into what we would see, SpaceX, and I know Gemini and SpaceX are both kind of vying for those different things. But there's a lot of things that will happen in the next couple of decades that people, when they looked at investing 20 years ago, had they been into Microsoft, Apple, Amazon, and maybe 15 years ago into Facebook in the early ages, obviously those people are multimillionaires now, if not billionaires. So they definitely caught on to what was at that era the innovation funds of those eras. What you're representing, I think, is really kind of an open window to a very unique and different place of how investing will be structured in the future. I'm just kind of curious, do you feel like at some point Wall Street's going to have to just say, listen, this is the new landscape. We're going to deal with it this way, and we need to start charting our course forward. What are your thoughts on that?
Now, look, they will be disrupted the same way media was disrupted by the internet, right? When we were growing up, we would run home on Tuesday night to be at our TV tray at 8 o'clock to watch Happy Days and Laverne and Shirley, okay? That's what we did. And ABC, NBC, CBS, they owned everything. They owned our eyeballs. They owned the advertisers. They had huge market caps. Today, they're a fraction of their former selves, and all their market cap went to Netflix. How? Why? They could have just digitized. They could have gone to a subscription model. They can't do it. They could not give up their ad-based revenue model. Wall Street wouldn't have let them, right? Because they would have missed earnings for a couple quarters. But Netflix hasn't made money maybe ever. I mean, in terms of actual making money, but no one cares. They just look at the growth and they look at the eyeballs and they look at the control of time. And so the disruptor disrupted the incumbents. And the same thing's going to happen on Wall Street. So DeFi, decentralized finance, CeFi, centralized finance like BlockFi and Coinbase are going to take share from Wall Street. And at the end of the day, Mark Andreessen was right. Software is eating the world. And it started with media and commerce. And now it's going to banking and value. And look, every stock, every bond, every currency, every commodity, every physical piece of real estate, every piece of art, every bottle of wine, every collectible car, everything will be digitized, will be traded 24/7 in a borderless, non-nation state marketplace. And all that will be done with cryptocurrency and tokenization. And these middlemen are going to lose out. And they could have tried to embrace early, but it's just not in their DNA. Disruption happens. And it's happened. And here's the crazy thing. It happens and everybody worries about it and everybody wrings their hands and they try to put up regulation to stop it. And today we have more jobs than we've ever had in the history of our republic.
Right.
Even though we've destroyed all kinds of jobs along the way. And those people losing those jobs get really unhappy about it, like street sweepers who passed out pamphlets in New York saying, if you got in a horseless carriage, you die. Which is silly, right? I mean, you could die in a horse-drawn carriage just if it turned over just as easily as a car. But they didn't want to lose their job. And same thing, I grew up in Seattle. Most of my friends don't work anymore. I was too dumb to go to work for that little company called Microsoft. Although I defend myself saying, if you ever seen the picture of the original Microsoft 11, you'd forgive me because they were a little rough looking. We were all rough looking in the 70s, but that was a pretty rough crowd. They've all done great. They're all gazillionaires and multi-billionaires, and Microsoft has changed the world. And every evolution of technology that has followed that has changed the world, from mainframes in 54 to the microchip in 68 to the personal computer in 82 to the internet in 96 to the mobile net in 2010, and now the trust net, where blockchain is the infrastructure in 2024. We're just getting warmed up, and the opportunity set in front of us is extraordinary. Absolutely extraordinary. And it's why my pinned tweet on Twitter is the greatest wealth is created by investing in something that you believe in before others even understand. You'll be mocked and ridiculed, but it's worth it.